Well, first I want to welcome everyone to this webinar. As I mentioned, this is the first of many videos that we're going to have for the next 2 months. We're pretty much going to meet here every Wednesday night at 8 o'clock, and we're going to go roughly about 10 o'clock. This is an open webinar, so I want you guys to ask questions as we move forward. Okay? Don't be shy to ask any question. No question is stupid out there at all. And remember, this is for beginners only moving forward. So we're assuming everyone on this call is beginners or newbies with little knowledge on either the Forex market or the futures market. And we're going to proceed forward where we're going to cover a lot of information in the next 2 months. Today we're going to cover the Forex basics, which is for the currency side. We're going to go through terminology. We're going to go for how to place buy orders, sell orders, things like that. Then we're going to proceed forward with the fundamental side on both the futures and the Forex side. And then we'll also evolve into doing the technical side too, where the technical module will pretty much take almost about a month to go through. Reason why is we're going to cover all the major indicators out there that you may have heard of, from moving averages to RSI to CCI to MACBB, if you've heard of it, to stochastics and so forth. So, we're going to cover all that. We're going to also cover Elliott wave analysis, Gann theories, Fibonacci's, everything out there. And we're going to go through and teach you how to use each one of them and move forward from there. Okay. In the webinar, I'm going to be using a brokerage platform from TD Ameritrade called thinkorswim. You don't have to have thinkorswim at all. But if you do, that's fine. You can follow along, but you could use anything I do in any of your charting or brokerage platforms out there. Okay, so just because I'm using one platform doesn't mean necessarily you have to use the same thing out there at all. Okay, I like thinkorswim from TD Ameritrade in Canada. It's just now starting to get available, so it's not that popular out there. A lot of people use a platform called MetaTrader 4 or 5, version 4 or 5 for the currency world. You're more than welcome to use that too. But for the lessons and everything we go through, I'm going to stick with my charting platform, which pretty much will work the same way for yours, whether you use MetaTrader, thinkorswim, NinjaTrader, or any other brokerage or charting platform out there. Okay? Any questions before we begin? Okay, if you want to know more about me, you can see at the bottom of our slide here, this is ichimokutrade.com. That is basically our website there, which is hosted by EII Capital, which is pretty much who I belong with. I'm the president and CEO of EII Capital. Okay? So as we've talked about, the first webinar we're going to go through is going to be talking about the Forex basics. Okay, so we're going to start off talking about the basics. So the very first question we're going to go through, before we go for anything, we need to go for a disclaimer. Everyone should take the time to read this disclaimer. This is to state that basically the webinar that we're doing today and all the future webinars are for educational use only. We're not telling you to buy or sell anything at all. Okay, and all the material that we're going to go through, including the recordings, the PowerPoint presentations, the knowledge, everything is pretty much owned by EII Capital Incorporated. You must get permission from us to distribute any of the information out there. Okay. Also, all the charts, as I mentioned, are going to be either from thinkorswim, which is from TD Ameritrade, or TradeStation. Okay. Now, if we look here, this webinar, we're going to try to get for all 4 of these chapters today. I believe we could get through them in the 2-hour time frame, about an hour and a half time frame. But if we don't, we'll move some of these topics into the next seminar. But our goals are to pretty much go for these 4 chapters. The very first chapter is why trade the Forex market. As you know, there's many, many markets out there, from the stock market to the currency to the futures to the bonds. And then you also get the fixed income, which is credit swaps and stuff like that. Why should you as a retailer sit there and trade the Forex market? Okay, so we're going to go through that in great detail and discuss that in great detail. The second chapter we're going to go through is we're going to analyze who is our competition. Just like in the business world, you got to know who you're competing against. Reason why is you got to remember, if you're buying something, there's got to be someone on the other side. And if it's that great, why would someone be selling it? Okay? Or if you're selling something, why would someone sell it when it's that great? Okay? So you got to think about it. Whenever you buy something, there's always someone on the other side selling, and when you sell something, there's always someone on the other side buying. So you got to know who your competition is, and you got to sit there and be on the right side of the competition. If you're not, you're definitely going to lose. Okay? And you got to sit there and be on the right side where all the big money is. If you're on a side with where all the little money is, then you're going to lose and you're going to be taken for a ride. They may sit there and give you profits for a while, but they eventually will sit there and take it back within a day or a couple of days or maybe even a week, where you probably could see in one day you could sit there and wipe out 2 years of profits very easily. If you haven't experienced that yourself, you could sit there and talk to many traders out there where they'll say this month they lost so much money that they lost all their profits that they've made in 2 months. So we want to avoid those type of situations, and we want to become a consistent, successful trader. That is our goal, okay? And that's one of the reasons why we analyze the competition, and we want to make sure we trade just like all the big boys do that have all the big money, okay? Next, we're going to go for the mechanics of Forex trading. We're going to talk about if you have this currency, which currency you're holding, what a pip is, what a denomination of 10,000 means. Do you really have $10,000, or do you have to put up 10,000? We're going to go for all that terminology, everything out there, because a lot of this stuff is misleading, and a lot of this stuff is irrelevant too, believe it or not. And a lot of the brokerage firms out there will sit there and talk about some of this stuff, and it's irrelevant at all, and it's just a waste of time going for it. And you're busy sitting there trying to learn something that you really shouldn't, and you should be concentrating on other things. Okay? And then lastly, we're going to talk about the different types of orders out there. A lot of people will sit there, understand the terminology on the Forex side, but when it comes time to implementing it by placing an order to buy something or to sell something, they really don't know how to do that. So this last section we're going to go through in great detail. When you buy something, how does that look physically in your brokerage platform? What do you do? Is it a stop order? Is it a limit order? What does those words mean if you don't even know what that means? Okay, and we'll discuss that in great detail. Okay, does anyone else want to see anything else, or does anyone have any questions at this time? Okay, I think we're good. Let me just make sure we're over here. Okay, so the first topic we're going to go for is why trade the Forex market? That's the magical question, okay? As we were talking earlier while everyone was getting online, we were talking to a gentleman on the call that basically was a stock trader, and we're going to talk about this, and we're going to compare actually the currency side to the stock market, okay? And you're going to see why it's a huge advantage to sit there and trade the currency market compared to the stock market. Okay, the very first main reason why a lot of people trade the currency market is due to liquidity. Over $2.0 trillion are traded daily, not weekly or monthly, but daily. Okay, so you know that everyone is sitting there trading the currency market. There's a lot of people out there. Okay, liquidity matters. Reason why is, let's say you bought a position and it goes up and you're profitable. Now you want to get out. If there's no liquidity, that means there may not be any sellers for you to get out at the price that it shows on the market ticker, okay? So that's going to be a problem, right? So at that point, you want to be able to liquidate your position, but there's no sellers there for you to sit there and sell to. Sorry, there's no buyers there that are there where you could basically sell to. So at that point, you have to adjust your price and give up some of your profits just to sit there and find someone to sit there and take your position away from you. That's not good at all, okay? When you get into something, you want to be able to get out right away, and that's what liquidity means, okay? So you don't ever have to worry about liquidity at all in the currency market. Reason why is there's a lot of money traded daily. In the futures market, you do have that problem with liquidity. If you start trading futures such as for lean hogs, for butter, even cotton at some points, you may have problems where there's no liquidity at all. So if you're trying to buy something, there may be no sellers. If you're trying to sell something, there may not be any buyers at the price that you're looking for. So that's going to be a problem there when you start dealing with the futures market. But when you start dealing with a currency market, you really don't have that problem at all. Okay? The second great advantage of the currency market is it is the best trending market out there. Now, what do I mean by trending? Okay? There's three types of markets, which ways the markets can go. Either they could go up in a continuous fashion, which will look like something like this, where it goes like this, continuously up, or it could go down in a continuous fashion, or it could just go sideways. Okay? You really don't want to trade a sideways market at all. Okay? That's where you're going to lose the most money out there. What you want to do is, if you're betting on an instrument going up, a currency or stock or anything out there, you want to get in, and then you want to see that instrument go up in a continuous fashion. Okay? That's called a bullish trend, is when it goes up in a continuous fashion, going up nicely with kind of like a 45-degree slope where it just keeps on going like this. Okay? A bearish trend is where basically you're betting on the instrument going down, and it goes down in a nice orderly fashion, which is like this. Okay? Is everyone okay with the terms for trending? Okay, so everyone should understand what a bullish trend is and a bearish trend. Okay? Everyone understand that? Okay, I'm going to assume that's a yes. Okay, and the best thing about the currency market is that it trends the best compared to all the other markets out there, from stocks to futures and so forth. So that majority of the currencies, they're trending and they're not going sideways. Okay, now in the currency market, there's 96 currencies out there, but out of the 96, there's 36 now that are considered the majority of them. And if you narrow that down, there's really 12 of them that people count as the major currencies out there. And if you look at those 12 currencies, you will find that there's a trend in majority of those 12 currencies out there, whether it be bullish or bearish. Okay, so it gives you a huge chance of being correct, even though you may not know what you're doing, and gives you a nice reward risk ratio where you could risk $1 to try to make $8 or $4 or $8 or so forth. Okay, in a sideways market, which is called swing trading, right? A lot of people will sit there and try to risk $10 to make $1, which is deadly. Okay, but that's what a sideways markets will give you. You really want to sit there and be a trend trader where you're going to risk $1 to try to make $4 or more. Is everyone clear with that? Okay. The third advantage here that we're going to talk about is a great way to hedge your portfolio. Okay. Now, this is kind of confusing to some people. If you don't understand what I'm talking about here, don't worry about it. But this is a great way to hedge. So let's say you're going to Europe, okay, and you know that you're going to go to Europe in 1 month's time. And you know that basically right now, the euro, if you convert US dollars to euro dollars, you're going to get a good conversion rate. Well, you may be scared by the time you go there in 1 month, the conversion rate may have inverse, where the point is that $1 is going to be worth not even $1 in euro. Okay, so what you can do is go to the Forex market and hedge against your entire portfolio, your trip, or anything else out there. Okay, now this is a little confusing, so let's table this for a little later. Okay, where we're not going to discuss the hedging of a portfolio too much right now. But hedging mainly comes into plays where import-export companies that deal with foreign countries, they'll start doing this for hedging. So let's say GM has a contract with a Japanese company where they're going to deliver, the Japanese company is going to sit there and deliver 20 cars in 6 months' time for $1 million. Okay? So what will happen right now is Japan will sit there and figure out what $1 million is compared to the Japanese currency. So they know that on the U.S. side it's worth $1 million, but on the Japanese side it's worth X number of Japanese yen. Well, what they may do is if they're afraid that the currencies may change, they may go out to the Forex market and sit there and buy or sell the yen currency in opposite direction just in case if the conversion rate goes inverse so that they don't lose money when they sit there and have to deliver the cars in 6 months' time and they get the money in dollars. Because $1 6 months from now could be worth more or less than what it was from 6 months ago. Okay, and for us as individual retail traders, especially when we're traveling, it doesn't make much difference when you're sitting there converting $1,000, $10,000 or so forth. But when you start converting in the millions of dollars range, the conversion rate between what the conversion rate now and 6 months now or 1 year from now could be a big deal. Okay, so a lot of people will hedge by just sitting there going to the currency market and doing the opposite of what they're looking for. Okay, like I mentioned, if that you don't understand that, don't worry about it, and let's move on. The fourth point, as we talked about, limited number of currency pairs. As we talked about, there's only 12 major currency pairs out there. If you start getting into some of the exotics, you go up to 37, and then eventually you could get to 97. But in the stock market, you're looking at over 5,000 instruments. In the futures market, you're looking at over 4,000 instruments worldwide. So if you look at it, the currency market has the least number of instruments to look at, so it's very easier for students to sit there and learn how to trade currency market and be very effective, consistent traders by trading the currency market. Okay, the next one I like the most, it's a 24-hour market. Okay, the currency market sits there and pretty much trades 24 hours a day. So you could sit there and trade after work. If you wake up early, you could trade. You could trade during the day. Any time of the day, you could pretty much trade 24 hours a day, and we'll go through that. Okay. Next point, there's no time expiration. We're not dealing with options at all in the currency spot market at all, so there is no expiration for our contracts. When we get into a particular currency pair, there's no expiration at all, so you don't have to do anything where you have to close out this contract and buy the next month just because the contracts are about to expire. If you don't know what I mean by contracts, don't worry about it. Okay? And lastly, this is probably where people love the currency market more than the stock market. It's high leverage. What I mean by that is if you put $1 in a margin currency account and it's paying 400 to 1, that basically means that $1 now is equivalent to $400 where you can sit there and trade up to $400 in value. Okay? So if you put $1,000 in there, that's like you playing with, if you think about it, 1,000 times 400. So add 3 zeros, that's $40,000. Okay? Now, of course, the brokerage firm is not going to allow you to go negative and lose $40,000. They'll only allow you to lose what you put in. But you could sit there and trade an equivalent value of $40,000 if you put $1,000 in a 400 to 1 margin account. Okay? If you look at the stock market's accounts are only 50 to 1. That means they only require 50% of the margin. $1 you put in is equivalent to 50%, $50. Okay? Any questions so far? So in theory, you could sit there and you find the right broker, you could sit there and put only $250 in a Forex brokerage account and you could now start trading and you could turn that $250 into $1,000 to $2,000 to $5,000 to $10,000 eventually. Okay? Now, I'm not telling you overnight because everyone that tells you that happens overnight is not realistic. Okay? Remember, the goals are in the next 2 months is to be a consistent trader where we're not looking for fluke wins at all, but we're looking to be consistent traders where we know that we can make a residual income on a monthly basis where it pays you just like a job. Okay? Any questions so far? Reba's 400,000? Oh, 40. Okay, thank you. 400,000. Thank you. It's hard to see everything with one screen. Okay. So the disadvantages of the currency market, I want to emphasize this again, high leverage. Okay. Remember, a lot of you guys are going to sit there and you're going to sit there and open up these Forex accounts with 200 to 1 or 400 to 1. So when you $1 for every dollar you put in is equivalent to $200 or $400 out there. Let me warn you, Be very careful. Even though you got a lot of money you could play with, it's very easy to lose it too. Okay? So what goes up can go down faster too. So just remember that. Okay? I personally sit there and make sure my Forex brokerage account is set to 50 to 1. I don't want the extra money at all. Okay? And I mean, tell you that, I tell that to all my students too. Set it down to the lowest margin that you can. That way you don't sit there and have a chance of blowing yourself out and actually getting into a margin call where you now owe the brokerage money. Okay? The second disadvantage, and remember this was an advantage too, is it is a 24-hour market. Okay? So while you're sleeping, something can happen. And let me give you an example. Okay? While we were sleeping, 2 days ago, the Switzerland government came out and made an announcement, and before you know it, the Switzerland currency got weak all of a sudden, and it just jumped in 1 second drastically to the other side. The way to sit there and protect yourself and make sure that the 24-hour market is not a disadvantage is that you have to use stops. If you do not use stops, you're going to be sitting there asking for it, and you do have a high possibility of blowing out your account. I know there's a theory out there, okay, where people say that if you use stops, the brokerage firms could see it and they could do a stop run. That's not true, okay? Put your stops out there. It's better to sit there and have a stop than not to have a stop at all. Even if you feel, if you want to put it way far away, I don't care. Put it far away if you feel comfortable, but have a stop, okay? If anything you take from the 2 months and the only thing you take back with you is to have a stop, I'll be happy. Do stops hold when you're not online? Rebus had a question. Well, all the brokerage firms that I know, when you put a stop in and you close your brokerage platform, that stop is still there. Okay, that's something to verify with your brokerage platform out there. Reason why is there's so many brokerage platforms out there, Rebus, now that it's hard to sit there and guarantee something like that. So I would double check with it. If they don't, I would definitely find another brokerage platform. Reason why is almost everyone out there, even when you close down your platform, that stop is always valid. That is your protection against the black swan events that occur out there. Okay? And that's the only thing that's going to stop you from blowing out your account. Is everyone okay with that? Okay.
We have a hand raised, Manish.
Okay. Who had a question?
Zobia.
Zobia?
I have to ask for the leverage, so no, it's okay.
You okay with that, Zobia?
Yes.
Okay. Okay, so chapter 2, we're now going to progress and forward, and we're going to move into who is our competition. Okay? And remember, a lot of people don't look at who the competition is. In the business world, we do that on a day-to-day basis. You know, if you're Apple, you know who your competition is. If you're Caterpillar, you know who your competition is. If you know AIG, you know who your competition is. And you're always aware of what your competition is doing. In the trading world, unfortunately, people don't look at who your competition is, who you're competing against. But they really should. Reason why it really does matter, because in order to make a market, you have to have two people, someone to buy and to someone to sell. If you're buying, someone's always got to be on the other side of you selling. That's the only way you could sit there and buy something. Okay? So you got to remember that. If something's so good to buy, why would someone be selling that? Remember that. If you have to remember that in order to sit there and trade anything, not even just the currency market. You have to remember that even when you're trading stocks like AIG or anything else out there. Okay? If you look at the participants, okay, the very first top person on the participant list is the governments, the central banks. Okay? There are a lot of major countries out there. So you have the Bank of Japan, you have the U.S. Bank, which is called the Federal Reserve, you have the Bank of England, you have the German Bank, you have the Bank of China, you have all these major government central banks. They are the top person in this tier. Okay? When they make decisions, at that point, the currencies will move. Okay? And once we get into the fundamental side, you'll see exactly how they could make the currency market move. But just them sitting there coming out with a report will make will make those currencies move. People will either start selling or buying that particular country's currency. Okay? And when you get into the fundamental piece, we'll discuss that in great detail. Okay? But remember, they're the biggest player in this market. The second biggest player you have is the commercial investment banks, the interbank. Okay? Now, when you get quotes and stuff like that, believe it or not, they're the interbank rates. Okay, so they're the rates that you get in your brokerage platform. They're from all the major commercial investment banks out there. They're basically exchanging money left and right. Okay, so they are the second biggest player out there. The third biggest player is the international corporations. Remember we talked about a little about the hedging, which could have been a little confusing for you, right? This is where the third big player comes into play. So if there's a $2 million import-export deal, eventually that $2 million needs to be converted to that particular country's currency. So that will hit the currency market where it will go down to these interbank or the central banks, and it will get converted across. Okay, so that could be a huge amount of money that plays hands across the currency market. Okay. The fourth tier is basically the hedge funds, the institutional investors out there. Okay, this category now could be labeled also the high-frequency traders, as you've probably been hearing about in the last couple of days or last couple of weeks. It's the computerized programmers, all that out there. So the hedge funds are kind of grouped into that the black boxes, the high-frequency traders are grouped into that hedge fund category out there. And lastly, you could see there's you, the retail person. Now, let me ask you, where are you at on this list? At the top or the bottom? At the very bottom, right? So think about this. When you're sitting there trading, do you want to trade like a retail person, or do you want to sit there and trade like a commercial investment bank or a government bank or one of the top three tiers? Anyone? Okay. You want to trade like the big money up here, so you want to trade exactly what these guys are doing up here at the three. You really do not want to go against them. Reason why is they can move the currencies drastically. And when they move them, you want to be on the right side so you get taken for that same ride that they're going on. Okay? You don't want to get in front of them. This is like when the central bank decides to go in one direction, that's like a train going from U.S. to Canada, right? Do you really want to sit there and get in front of that train and try to stop it? If you do, what's going to happen? You go run over, right? You don't want that scenario at all. Okay, these guys are what sets the trends in the markets, especially the top two tiers here. They're the what sets the trends in the currency market, and you want to be on the correct side of them, not on the opposite side of them. Okay, so one of the things you have to do is you have to stop being a retailer, thinking like a retailer and trading like a retailer, and start thinking like the top three people here and start trading like they do. If you don't, you're going to lose. Because remember, these guys have to sit there and trade with someone. Who they're going to trade with? You. You're on the other side of the trades. Just like the international corporations. Who are they going to trade with? You. Hedge funds. Who are they trading against? You. Okay? There's a lot of retail traders out there, and if you think about it, if each person puts in $500 out there, that's a lot of money that these hedge funds are going to sit there and trade against and to take. And that's exactly what's happening over and over and over. Why? A lot of these brokerage firms out there, they're sitting there based on commissions. They don't care whether you make or lose money. All they care about is you trading. Okay? So they're going to sit there and teach you how to day trade, how to do these news trades and this and that. I'm telling you right now, if you sit there and learn how to do that, you're going to lose because you're doing exactly what everyone else is being taught is how to be a retail trader. Okay? You got to get out of the norm and sit there and start trading like the top two tiers here. And it's one of the reasons why we're having this 2-month webinar is to build upon everything so that you understand and you stop being a retail trader and start becoming an institutional trader, which is the top two tiers. Is that okay with everyone? Okay, moving on. Okay, so if we come here, this is the governments here. We're going to talk about each tier real fast. Okay, The government, remember we talked about this? This is the central bank, okay? They're the principal monetary authority for that nation. So they control their currency, okay? Their responsibilities are currency stability. They issue the currency. That means they could sit there, print the currency as much as they want, okay? Their goals, they control the currency and the movement of that currency by controlling the interest rate. Okay? When you sit there and you see, when we get to the fundamental piece, you'll see that if they increase the interest rate, that causes more buyers to sit there and want to buy that currency, so that currency will go up. So if Australian government comes out and increases their interest rate in that country, what's going to happen is that there's going to be more demand for that currency, so that Australian dollar will go higher up in the charts. Okay, and we'll talk more about that once we get into the fundamental piece of the currencies. Okay, also if you could see all the other agendas here for every government: low inflation, full employment, regulate credit systems, oversee commercial banks, manage exchange reserves. So the government, the Federal Reserves, or the central banks have a lot of responsibilities there. Okay, and you could see all the 8 major central banks are listed here, where you got the United States, Canada, Europe, UK, Switzerland, Japan, Australia, and New Zealand. Okay, now there are some others outside the 8, like China and stuff like that, but most people view these as the major 8, which pretty much control the currencies around the world. Okay, the next tier, my PowerPoint will move on, is the interbanks. The major commercial banks basically buying and selling among each other. This is about 75% of the Forex volume consistently in the bank trading between each other. Okay, as I mentioned, when you get rates, the bid and ask for these particular currencies on the brokerage platform, they're from these interbanks because they're 75% of the Forex volume out there. Okay, banks deal directly with each other based on the credit relationships with the counterpart banks. Okay, we're not going to go through all these in detail, but there's 3 components to the interbank: the spot market, the futures market, and SWIFT. We're not going to talk about SWIFT. Futures market we'll talk about a little later, and then we're going to talk about the spot market. Okay, spot markets when you're dealing directly with the currencies, like if you deal with pound, yen, euro, USD, and so forth. If you start dealing with futures, there's a limited number of futures. Okay, and we'll talk about these 2 as we go on in the presentation.
Manish?
Yes.
We have a question by Mr. Asad Khan.
Okay. Asad, go ahead with your question.
Yeah, hi Manish. You mentioned that. Hi Manish, can you hear me?
Yes, I could hear you.
Okay, so my question was that when you raise interest rates, then it could be because of higher debt of a government. So do we need to consider that also?
Well, we're not going to go through in detail right now. There's going to be a whole webinar on just the fundamental piece, which will talk about the debt, which will talk about the inflation, all that stuff, which governs the interest rates. Okay?
Okay.
So just be patient, and we'll get to that. We're gonna go for a whole 2-hour webinar and just talk about fundamentals, what reports will affect the interest rates, which will in turn affect the currency.
Okay, thank you.
Okay. Okay. So remember, this is the heart of the Forex market here. Okay. Next is the corporations. As we talked about, import-export businesses cause corporations to become major players. This only happens when mergers and acquisitions and import and export starts occurring. Okay. Here's some examples here we're going to give you, but we're going to talk a lot more about this once we start getting into the fundamental piece, because this deals with some of the fundamentals too. Okay. So remember, we'll talk more about this. You got the video here, which goes through the slides so you could read through this, but it's not worth taking the time to go through this in great detail. Okay? Institutional investors, basically, these are the large mutual and pension funds out there, hedge funds, and black boxes, which is basically the automated computer strategies out there. Okay? They have the ability to enter huge orders without skewing the market due to liquidity. Remember, in the stock market, these computerized programs, they can enter huge orders, and those huge orders will influence the stock market, especially one particular stock, because there's not many buyers or sellers in there. Okay, in the currency market, there's $2 trillion traded daily. So it is very, very hard for one computer programmer or one big major institution to sit there and move the markets drastically. Okay, really what moves the markets drastically are the central banks with interest rates. Okay, and they set the precedence with supply and demand for that currency. Okay, and then lastly, it is you as the retail trader. Everyone okay with that? Okay. Next, we're going to go for the mechanics. Now, I want you to bear with me on this, okay, because this is where we're going to go through terminologies and everything else out there, okay? So this could get a little difficult or it could get very easy. So first, let's describe what a pip is. In a stock world, when things move, they move in terms of pennies. Everyone agree? The lowest denomination in the stock world is a penny. Then it could move 10 cents. Then it could move $1, $2, $3, $4, whatever. Okay? So lowest denomination in a currency world is called a pip. Okay? That's equivalent to almost like 1 penny movement. Okay? And we'll talk about that in a minute. Okay? So pip really, the meaning of pip stands for price interest point. You really don't need to know that at all. Okay, the key thing about a pip is what we need to understand is 1 pip is equivalent to $1. Okay, now I'm saying equivalent to $1. Okay, sometimes it could be 98 cents. $1 pip could be 98 cents. It could be $1. It could be $1.03 or so forth. But the way I always look at it is 1 pip is roughly $1. Okay, and that's the best way to sit there and look at it and visualize. If you go with that assumption, then you're going to be fine. Is everyone okay with that? Okay. Now, to confuse the retail people, they came out with what you call micro pips. Okay. So this is a mistake. It's not half of a pip. A micro pip is 1/10 of a pip. Okay. So that's like a penny. Dealing with a penny. Let's change this right now. Okay. So this is a 1/10. Okay, so that's 1/10 of a pip. So if you think about it, if 1 pip's $1, then 1 micro pip is what? 10 cents. Everyone understand that? Yes? Okay, great. Okay, now remember, I'm trying to build out mechanics, so I'm going to keep on asking you every step of the way as we go forward, and you got to make sure you understand everything as we go forward from there. Okay? Now, if you're dealing with 10 cents, you really don't need to be trading the currency market or anything else out there. Go back to your J job, okay? If you can't sit there and risk $1 and play with pips, then you really don't need to be trading anything or at all. You need to go back to your day job and not trade, period, okay? If you got to at least have $1 investment, okay? Dealing with micro pips is really a ridiculous game. There's no way you're going to become a consistent, successful trader and start trading like institutional traders if you're dealing with micro pips, which is pennies. Okay? You really need to sit there and trade a scenario where 1 pip is $1. Is everyone okay with that? Okay? So from this point on, I'm not going to talk about micro pips except for certain scenarios. I'm always going to assume we're going to talk about pip, where 1 pip is $1. Or in Canada, 1 pip is $1 Canadian dollar. Or in London, 1 pip is £1. Everyone okay? So 1 pip is equivalent to whatever currency you're in, but $1 of it. Okay? Now, here's the thing. Currencies either go out 4 decimal places, like this, or they go out 2. Okay? Now, when you see that extra digit, that's that micro pip, so we're not going to deal with that at all. But if you see a platform that has 3 decimal places on there, get rid of the 3rd one, and that's how you look at it. If you see something with 5, get rid of the 5th one, and this is how you look at it. So you should always think in terms of 4 decimal places or 2. Is everyone okay with that? Okay? Now, 2 decimal places usually come when the currency pair that you're dealing with has yen in there, which is Japanese yen. JPY is the abbreviation for Japan's currency. When it has 4, that's typically dealing with dollar-denominated currency pairs. Everyone okay with that? Okay, so if my charting platforms tells me the price is 97.24, everyone see that? We're dealing with 2 decimal places here. This last digit here, if it goes up one pip, that's going to 0.25. If it goes down 1 pip, that's going to 0.23. Everyone see that? If this goes down 100 pips, if this goes up 100 pips, that's going to go to 98.24. Okay? Is everyone clear on that? If this goes down 100 pips from here, that goes to 96.24. Okay? So, Muzamo, I'm going to unmute you so you can ask the question. Okay, ask the question. Hello? You there?
Can you hear me?
Yes.
Okay, I have 2 questions.
Okay.
My first question is, you mentioned that for JPY, the decimals will be 2 places, and for the US related pairs, the decimal will be 4 points, right? 4
Yes.
places.
Yeah, in your charting platform, you may see 5 for dollar and 3 for yen, but just ignore that last one.
So my question is like, let's suppose we take like British, for example, Euro and US. So in that pair, we will see 4 decimal pairs on the both sides, right?
You'll see 4 decimal places, so you'll see a quote that goes out to 4 decimal places.
Okay, and if we are trading, we are like, bundling up like Japanese yen with Euro, the decimal places will be 2 on both sides, right?
Yep.
But what if like, if we are pairing up Japanese yen and US dollar?
I'll show you that. Okay?
Okay.
I'll show you that. But here's the thing, okay? The thing is, don't get caught up in 2 or 4 or anything like that, okay? Remember one thing. The number of digits should be even, okay? When you see an odd digit, get rid of it. Just throw it out the door, okay? And make your life easier, okay? And then what happens is just look at this last number, and if it goes up by 1 point, that's 1 pip. If it goes down 1 point, it goes down by 1 pip. Same thing over here. Does that make sense?
Right.
So notice this 24 goes to 25. That's going up by 1, right? That's 1 pip. From 24 it goes to 23. That's going down 1 point, right?
Yeah, but like as you mentioned that 1 pip is like roughly $1, right?
Right.
So if the current price is 97.24 and if it goes up by 1 pip, it should be 98.24, no?
No, that's going up by 100. That's the thing. That's the confusing part. Don't think in terms of dollars like you go in a grocery store or anything like that. Okay? When this 4, this last digit here goes up by 1 point, that's equivalent to 1 pip. So when this 4 number, notice how you have 24, right? If this 4 goes to 5, that goes up by 1 pip. If that 4 goes to 3, that goes by 1 pip. Okay? Same thing over here. If this 2 goes up by 1, if this 2 goes to 3, that's 1 pip. If that 2 goes goes to 1, that's 1 pip down. Okay?
Perfect. All right,
so
thank you.
If this 1 right here goes to 2, that went up 10 pips. If this 1 goes down to 0, right, then that went down 10 pips. Does that make sense?
Oh, so the thing is like it's kind of a subtraction, that's taking place on the digits.
Exactly. One way you could do it is if you have decimal places, right? Just get rid of the decimal places. So the way you could look at it is this is always 97.24, right? And if it goes to 97.25, how much is that? 1 point, right?
0.01, yeah.
Right. So that went up 1 point, so that's 1 pip. So if decimal places confuse you, get rid of them. Just move them over, like just move this over by 2 and always deal with no decimal places. Over here, this will be 12,012, right? If it goes to 12,013, how many points did it go up? 1.
1.
So that's the way you look at it. It's 1 pip. Okay? Now, this works. If you get rid of the decimal places, it works as long as you have an even number of digits. Don't use that micro pip. When you use that micro pip, it throws things off. Okay?
Okay.
Almost all the brokerage firms now are dealing with this stupid micro pip. Used to be very simple. Okay? But now they complicate our lives. So I always just get rid of it and just do this. In my mind, I ignore that decimal place and think of this as 9724. And over here, I think of this 12,012. Because I was brought up with a lot of whole numbers in my mind. Okay?
All right. Thank you very much.
I mean, people have a hard time thinking of fractions, so this is the best way to get rid of fractions. Is everyone okay with that? You have to understand this before we move forward. Is that yes? Okay.
From my side, yes, yeah.
Okay. Okay, we had two questions. Okay, Rebus, I'm unmuting you guys that have questions, so go ahead.
So my question is, if it goes up by 100 pips, that means you just earn 100 pips in that currency, right?
Yes, and if one pip is roughly $1, that means you made $100.
Okay, just trying to clear that out.
Okay. Mohammed?
And,
Go ahead. Rebus, whoever is the next person?
yeah, it's Rebus here.
Okay.
This one pip is roughly $1 thing. Is that, I'm trying to figure out why. And is that have something to do with the leverage and or the lot size?
Well, don't worry about the lot size right now. Okay. Just take it for granted one pip is $1 for right now, and I'll tell you why in a minute.
Oh, okay. Cool.
Okay. What I'm doing is, I've been teaching currencies for a long time now, and we've kind of mastered how to take beginning traders and teach them step by step the currency world. So I'm taking you through a logical progression of building up on lessons. Okay? So just take it for granted right now, one pip is $1. If you could understand that right now, everything's going to be very simple.
Cool.
Okay,
I'm okay with that. I'm okay with that. Yeah.
Okay. And I'll explain the rest of your question in just a sec. Okay? So is everyone okay with this? If you're not, please tell me right now. Because the knows what matters right now. Okay. So we're going to move forward. Okay? Remember, if you don't understand this, then make sure that you just get rid of decimal place completely. Okay? By converting everything to whole numbers, and it'll make sense. Okay, now, moving on. Can everyone see my screen here? Okay, so some brokerage platforms will show you a little dashboard like this. Okay, some won't. Okay, I'm going to explain this dashboard to you. Notice there's how many decimal places here? 5, right? Notice the pip is here. See this last digit? I'm going to throw away. So I'm going to throw away that 9, and I'm going to throw away that 4. Everyone understand that? So this really is 1.4873 on the sell side, and this is really 1.4875 over here. Everyone okay with that? Ignore the sell buys and all this quantity and all that stuff. Everyone okay with that? Okay. In this dashboard, again, this thing goes out too many decimal places, right? So I'm going to bring it over 1. If I get rid of one decimal place, I bring that over here. That tells me one pip is roughly $1. And we're going to go for that in a minute. Okay? Now, next thing we're going to talk about is what we call a spread. Okay? A spread is the difference between what a bid and ask is. Okay? Now, the bid are the people that are trying to buy. Everyone okay with that? And the ask is the people trying to sell. Okay? So the buyer wants to buy something at a certain price, and the seller wants to sell something at a certain price, right? The difference between the buy and the bid, the sell price, is the spread. Okay? Now, there's always going to be a difference, and the reason why is that is the commission for the broker. They tell you they don't have commissions, but they do. That is the spread, and that is the commissions. Everyone okay with that? Okay? So if you look here, and let's say this is the buyers over here, 4873. Okay? The sellers are here at 48.75. If you subtract the two, this is 1.4873 and this is 1.4875. So if you subtract the 75 from 73, what do you get? 0.0002. That's 2 pips. That's a 2 pip difference, isn't it? That is the commission that you're paying on this particular currency pair. It's 2 pips for this particular currency pair. Okay? Everyone okay with that? Now, the confusing thing is this is the bid right here and that's the ask. But yet they're telling you to sell. Reason why, this is the buyers. This is a snapshot from my brokerage platform. Remember, the buyers you have to match up with the sellers and sellers you have to match up with the buyers, right? So if this is the bid, the people buying, and I want to match up to there, I need to sell to him at that price. If this is a person selling, I need to buy to get to him. Everyone understand that? That's why these things are reversed. So this is sell and buy button because it's assuming that I'm going to sit there and I'm going to sell to the bidders, which is the buyers here, and I'm going to buy to the basically the ask price, which is over here. Everyone okay with that? Okay. Now, here's a thing that you have to be very, very cautious of. Most charts display the ask price.
Manish,
Yes. Yes.
we have a question from Muzammil.
Yes.
Muzammil, go ahead, please.
Yeah, my question is, as you mentioned, the spread was like 0.0002, right?
Yes.
In this particular scenario, the spread was 0.0002.
Yeah.
So, I mean, like this spread depends upon the quantity we are buying or selling, right? Multiply by that factor.
No, that's where I said, remember, 1 pip is equivalent, right now, I just told you that's 2 pips, right?
Mm-hmm.
The quantity will change. I'll tell you about the quantity in a minute. Just go with me for, right now, this is a 2 pip spread. You okay with that?
Mm-hmm. Mm-hmm. Yep.
And 1 pip is equivalent to $1 right now.
Yep.
Okay, I'm making an assumption which I'm going to get to in a minute. Okay?
Okay. Mm-hmm.
You okay with that so far?
Uh-huh. Yeah.
Okay, so another way, if you don't like decimal places, this is 14,873, and this is 14,875. So if you subtract 14,875 from 14,873, what do you get? 2.
2.
Yep. So that's a 2 pip spread. Everyone okay with that? Okay.
Mm-hmm.
Now, okay, so let's move on, okay? Now, here's the thing. Every one of you guys has got to find out your brokerage platform. When you see a chart, are they showing you the bid price, which is the buyers, or the ask price, which is the sellers? Everyone understand that? Okay? Most charting platforms, believe it or not, show you the ask price, which is the sellers. Okay? So whenever you're buying, you're going to be matched up to the exact price on the chart. Okay? But when you're selling, you have to incorporate the spread. Does that make sense or no? One person said yes. Who doesn't understand? It's a hidden fee, yes. Remember, if your chart displays the seller's price, right? If you're buying, you'll automatically be matched to the seller's price, which will be the exact price on the chart. Okay? But if you're trying to sell and your charts are the seller's price, you're not going to get filled right away unless you go down a couple of points, a couple of pips, the spread, i.e. the spread, to go meet the buyers. Remember, the difference between the sellers and the buyers are the spread, right? So if you want to get filled and you're trying to sell something and your charts are set up to show you the selling prices, which is the ask prices, you're not going to get filled unless you sit there and you go meet the bid, which is basically a spread away. So if you're trying to sell something, then you have to sit there and subtract the spread from your chart price. Okay, this is assumption where all your charts are showing you this ask price, which is basically the selling price. Everyone okay? My charts are set up the other way, where my charts are set up where the bid, all my charts are showing me the buyer's price. So when I buy, I have to add the spread to my buying price. So if I'm buying a currency pair and my price on the chart shows me 97.24 and I want to go ahead and buy it, I can't buy it for 97.24 because I'm going to be with all the other buyers. It will never fill. The only way I could buy it is if I sit there and try to buy it at 97.26, which is a 2-pip spread, then it will get filled right away. Everyone understand that? You have to take your spread and you have to add it to the basically whatever the opposite is. So if you're showing you the selling prices here, right, then you need to, if you're trying to sell something, you need to add it to the sell side. If your chart shows you the buying prices, whenever you try to buy something, you have to add your spread to the buy price that's shown on your chart. Everyone okay with that? It's confusing from the stock world because in the stock world they go off midpoint. Any questions? No? How are we doing for time? 9:11, not bad. Okay, so now we're going to get into quantity. Okay? Everyone okay with that? Okay, now, up to this point, we roughly said 1 pip is $1. Okay? That's assuming you're going to trade with a quantity of 10,000. Now, this doesn't mean you have to have $10,000 in your account. Okay? Remember, you have a 400 to 1 margin in some Forex accounts, okay? So you really don't have to have that much at all. What this is telling you is I don't even look at the quantity anymore, okay? The way I look at it is I'm going to deal with everything in terms of 10,000 and I'm going to increase this number. So if it's 10,000, I know that's 1 pip is equivalent to $1. Everyone understand that? This is your reference point. This is your foundation. If you assume that 1 pip is always $1 and that's for a quantity of 10,000, it's going to be easier for you to calculate everything from this point on. Okay? If you try to do something else outside of that, you're going to get confused. Because what happens is 1 lot is equivalent to 100,000. Now what is 100,000? That's 10 times these 10,000, aren't they? So if you think about it, 1 lot is equivalent to 1 pip is worth $10. And all 1 lot is just 10 of these mini lots. Okay? So remember, 1 lot right here is equivalent to 10 mini lots. Okay? So if you think in terms of that, if you're ever dealing with 100,000, that's basically just multiply that $1 times 10, and that's what each pip is basically worth. So 1 pip is roughly equivalent to $10 when you're dealing with a quantity of 10,000. When you're dealing with a quantity of 100,000. When you're dealing with a quantity of 10,000, 1 pip is roughly equivalent to $1. Is everyone okay with that? This is the time to ask the questions. No questions? I can't be that good. Come on. There's got to be a question here. No questions? No questions? Wow. Okay. I guess that was easy then. Usually there's a flood of questions that come in right now. Okay? So now, okay, maybe finish the slides then I have a question.
Manish.
Okay.
Mohammed, go ahead, please. Mohammed Galan, go ahead.
Can you hear me?
Yep.
Okay, so I just want to clarify. 1 mini lot is a 10,000 quantities, which is 1 pip, correct?
Yep. Yep.
Okay, so all right, then I'm just clarifying that.
Yeah, so if here, right here, if this is 10,000, I'm dealing here, every pip movement in here is basically $1. If I put a quantity of 100,000, every pip movement is going to be equivalent to $10.
Okay.
Okay?
Yeah.
Now, here's, remember I told you roughly $1, right? It could be off by 10 cents. Notice in here, if you're dealing with CAD yen, it's equivalent to not $1, 1 pip, it's equivalent to 1.10. If you're dealing with Euro USD, it's 1.00. So you're going to have little variations where they're roughly equivalent to $1, but not quite. Reason why is here it's more because there's no dollar. I'm in the US, so when they trade this currency pair, right, I'm going to either be holding Canadian dollars or Japanese, and they have to convert back to US dollars. So there's a difference of 10 cents off a dollar. You guys see that? But if you're in your mind, just think always $1, you're going to be fine. Okay? Can I move on? I guess so. No questions. Okay, moving on. Now, here we go. This is probably the hardest part for people to understand. So let's start doing this. When you're buying a particular currency pair, so let's say I buy 10,000 Euro USD at 1.1899. Everyone okay with that? When you're buying something, it basically means you're going to borrow the currency to your right and convert it to the currency to the left. So in theory, I'm holding the euro dollars. So what I'm doing is I'm going to sit there and borrow 10,000 US dollars, and I'm going to convert them all to the euros, and I'm going to hold the euro. And the conversion rate is going to be 1.899. Everyone okay with that? I'm assuming yes. Okay? So if I'm selling something, it's the opposite. Okay? I'm going to borrow from my left this time instead of the right here, and I'm going to convert it to yen. So I'm going to borrow 10,000 Canadian dollars, and I'm going to convert them to the Japanese yen at the exchange rate of 85.45. Everyone okay? And remember, I'm selling, so if I'm selling, I'm trying to match it up with the bid, which is the buyers. If I'm buying something, I'm going to try to match it up with the sellers, which is the ask price. Okay? This quantity here tells me how much every pip is going to be worth. So if I'm buying this currency pair, I'm wanting to go up. So if in order for me to make money, this would have to go up. So if this is 1.8900, so if this goes to 1900, that basically means I made 1 pip. If this went to 1800, that means I lost 99 pips. Okay? Over here, if I'm selling, and this goes to 8500, let's say this was 85.45, and this goes to 8500, right? I basically made 45 pips times $10, so that's 450. Everyone see that? Remember, this is 10 lots. So every dollar is worth, every pip is worth $10. If this goes to 8,500, this moves down 45 pips. And remember, I'm trying to sell, so I'm betting on this thing going down. So if this goes down 45 pips, I just made 45 pips. 1 pip is equivalent to $10 because of this. So I basically made $450 off this. If this goes to 8,600 over here, I basically lose 55 pips, so I lose $550. Everyone okay with that? Yes? Any questions? Okay. Now, in theory, you could get caught up with all this terminology of which one I'm borrowing, which one I'm holding. Really, all this stuff is irrelevant, okay? I'm explaining this because I have to explain this because I want you to understand it, but at the end of the day, I don't remember what I'm borrowing, what I'm holding around at all. If my chart tells me that the Euro USD is going up, I'm going to buy it. If it tells me it's going down, I'm going to sell it. If my chart for the CAD yen tells me it's going to go up, I'm going to buy it. If my chart tells me it's going to go down, I'm going to sell it. That's it. That's all that matters at the end of the day. Really, it doesn't. You're not going to sit there and worry about what you're holding, what you're borrowing, or anything like that. It's irrelevant. What matters is what the charts tell you. If the charts tell you to buy something, you buy the currency pair. If they tell you to sell something, bet on it going down, you sell the currency pair. Is everyone okay with that? So all this jargon here is crap. Okay? Everyone okay? Did I shock people? Am I losing people? It's usually, this is when people are like, okay. Now, here's the thing. Euro is called here, they call it single currency. Here's all these names you could think of. Sometimes they call the pound, British pound in London, the cable, the sterling. They call the dollar, the greenback, the buck, Japanese yen, Switzerland, the Canadian dollar, they call it loonie, New Zealand dollar, they call it kiwi. Here's all the names and all the names they give them. At the end of the day, I don't care. The reason why is I'm not sitting there watching the news at all. I'm sitting there trading the charts based on technical charts. Okay? And you're going to learn after 2 months why technicals make a big difference compared to fundamentals. Okay? And at that point, all this stuff is going to be becoming irrelevant when you're borrowing, when you're holding. Okay? Now, I know I'm getting against the norms of what these brokerage platforms teach you, but I don't care. This is the real world. Okay? Now, this is from Investopedia. Oh, okay, we had a question. Let me see. Go ahead. Your mic's open.
Hi. Okay. So in this screen, the scenario you have presented is like buy 10,000 Euro USD at 1.1899, right?
Yep.
In actual, in terms of currency, I mean, like this, I mean, like every transaction has a cost. Like even if you are buying or selling, there's a cost involved with it, right?
Right.
So this 10,000, should I multiply this 10,000 with 1.1899, and if my account is in like USD or whatever, so like that means that I am I'm spending this much of money to get this deal, right?
Now, what's going to happen is you're going to have a margin, okay? So you have a margin account. So what they're going to do is if you have a 400 to 1, right, they're going to take this 10,000, divide by 400, and they also come up with this other magical combination, okay? So what's going to happen is you're going to have a margin. So what I would do is find out what the margin is for like the Euro USD for 10,000, which is the lowest denomination. Most of the times it's typically around $200 to $300. Okay.
So you saying that like this scenario, the buy scenario, in reality has a cost of around $300?
No, it doesn't have a cost. That's the margin they allocate. Okay, that they hold. It's kind of like you buying a house. When you buy a house, right, and you put a down payment, you're building it, you put money in the escrow account, right, a down payment. So you can't touch it, and the builder can't touch it, right? So when you close out the trade, right? What you do in the brokerage platform is they take this margin money out of your account. They put it into this margin account, okay? So they take this amount from your total amount that you have in there, and then they put it aside. Why? Let's say you're wrong. They don't want to come hunt you down. They rather take from that escrow account, which is your margin account, out. You see what I'm saying? So what happens is that if you sit there and don't put a stop, then you could lose everything that you allocated. Okay? But let's say your stop is 40 pips away. Okay? Even though they may take a margin of $200, in theory, you're only going to lose $40. Does that make sense?
Yeah, I mean like I know, I mean like the margin, whatever the point, I mean like, but the thing is like, let's suppose if I don't want to play with the margin, I have $5,000 in my bank account. Tomorrow morning I just put that $5,000 into this whole brokerage platform, and I want to play with that $5,000, right? I don't want to go for any margins. So I mean like, let's suppose I have 5,000 US dollars, right? And I want to do the scenario as you presented, the buy scenario. I want to play with my $5,000 and do the buy scenario. I don't want to get into any kind of margins. So I mean like simply stated, like I mean like if I let's suppose it's a like a $5,000 combination with Euro USD at 1.189. So how much money it will go off? I mean, like how much money will go off from my account if you just forget about the margin?
Right.
Let's suppose I have like $20,000 in cash. I mean, like in liquid cash in my brokerage account, right?
Right.
And I'm playing this transaction, buy 10,000 Euro USD at 1.1899. So that means I have to multiply this 1.1899 into 10,000. That means like this much of dollars will be out of my my account, right?
Yeah, but I don't know of any Forex account that will not do no margin. Majority of them are pretty much margined down.
Oh, okay.
Unless you can find someone that it isn't. The margin is not a problem, okay? The margin is not going to be a problem. If you're worried about, okay, if I put in 5,000, will I go below 5,000, right? Majority of them will take you out of all your trades before you even go negative now, okay?
Okay.
So this is something you have to check with your broker and make sure that you never get a margin call. Does that make sense? So you never could go below zero. Even though they margin your money and you're using it, make sure with a brokerage firm that you don't go below zero. In certain scenarios, if a government comes out and make an announcement, it could gap. In that scenario, you may lose more than what you put in. And at that point, you get a margin call. But majority of the times, they're not even going to allow you to do that anymore. Everything that's happened in the last couple of years, there's safety factors there where they're not going to allow you to do that anymore.
Right. Okay.
Okay. I know where the question's going, and trust me, a lot of them now have safety factors where they will, even if you don't even have to get close, you don't have to go to zero. You even just get close to it, right? Maybe $20 profits, only $20 left in your account, they'll clear out all your positions. They'll automatically get you out of your positions before you even get to zero.
All right. So they have the authority to execute the buy or sell call.
Oh yeah.
All right.
Let me put it this way: they don't want you playing with their money.
Yeah, that's what I was trying to figure out.
Yeah. So I mean, the lowest margin you could get is 50 to 1. I have not been able to find somewhere where I cannot get margin at all. Okay.
All right. Thank you.
Okay, so now here's the trading times, the trading zones, okay? If you look at London, this tells you the open, the close, this tells you the active pairs, okay? If you take the European session, this tells you the open, the close, and it tells you, look, most volatile session most of the time. New York, here's all the times, busiest time is between 8 and 12 p.m. Asian, if you look at it, it basically starts off and you could 8 p.m. to 3 a.m. and you can see all the currency pairs that are statistically moving. Now this is from Investopedia, right? I don't know how long it was ago these stats were taken, but this is up to you to look at, okay? I basically don't sit there and look at these stats at all. I go where my charts tell me. If there's a trend, I trend, okay? Reason why is this is a global economy now where every Joe Blow has a computer, okay, and everyone's sitting there trading. So these statistics may not be valid anymore, okay? And let me give you an example. You may sit there and have the pound New Zealand sitting there moving during a New York session or a European session. It doesn't matter anymore, okay? But here's majority of the volumes from what Investopedia stated, and you could take these as guidelines. The key thing to this slide is you could see when these sessions begin and end, and you could see currencies start moving around these times, okay? Now, just because everyone, you probably have heard most of the currency movements are during the European session, that doesn't mean you have to sit there and wake up at 2 a.m. at 3 a.m. in the morning to trade. Everyone okay with that? You could sit there and still trade the New York session at 8 a.m. to 4 p.m. and still make money day trading or long-term trading. I don't care who told you that, but it's wrong. And I could prove that with our P&L statements from every one of my people in my chat room. Okay? So, you know, the myth that you have to wake up like 3 a.m. or 4 a.m. in the morning, no, that's not true at all. Okay? I typically will start my days at 7 a.m. if I'm sitting there day trading with students. We'll start around 7:30, 8 o'clock, and we'll sit there until about 11:30, and that's it. We won't even come back afterwards. Okay, if you're long-term trading, it doesn't even matter what these sessions are because you're sitting there off a daily chart and you're moving forward. And we'll talk more about that if some of those words are confusing a little later once we get into the technical side. Any questions? Now, here's a slide on the margin. You could read it on your own leisure time when you get the video. Okay, this talks about margin in great detail. Okay. Now, here, honestly, you don't have to worry about margin if you have stops. If you go in and you know what your risk is and you have a stop, then you typically don't have to worry about margin or getting a call from your broker and say, hey, you owe us money or you just blew out your account. Most of the people that we find out that get into margin calls are ones that don't have stops. Okay? Now, swap over rollover rates. So here's the thing. Okay? Now, when you put your money in an account, okay, there's what you call these swap over rollover rates, where basically you can make money off interest or you can lose money off interest. Now, here's the currency calculation over here. Okay? Everyone here? Hello?
Yep, we're here.
Okay, I just saw a degrade in GoToMeeting. Okay. At the end of the day, unless you got about $10–20 million, the interest rate's really not gonna make or lose money for you. Okay? Here's a calculation buying a Euro USD when the rollover rates were 1.3 at 5 p.m. Eastern Standard Time. And off one lot, remember one lot, that's equivalent to 100,000. $1 is equivalent to $10, right? This is how much you make or lose, which is $1. This is not going to do anything for you. So in terms of swap over interest rates, I ignore them. I don't even care. Okay? I'm not sitting there playing with a lot of money. I'm not playing with millions and millions of dollars in there where interest rates on your currency makes a difference at all. My goal is to make money off my charts and which way the currencies are going instead of trying to make money off the interest rates. The only people that try to make money off interest rates are when you're sitting there playing with millions of dollars, which are, i.e., the central banks and the interbanks. Is everyone okay with that? Okay, so this is another thing. Ignore this. If you hear about all these, I love these meetup groups that keep on happening all over the world where they say, oh, learn how to trade currencies, interest rate strategies. Well, these interest rate strategies, are you going to sit there and make 10 cents, 20 cents a day? Is it really worth your time to sit there and make 10 cents every 2 or 3 hours? I don't know about you, but in the U.S. we got minimum wage. You can sit there and flip burgers and make more money than sit there and make money off interest rates. Okay? So just don't worry about the interest rates at all. Everyone okay with that? Okay? Type of orders. This is where this gets a little confusing to everyone. Now, here's 3 types of orders that exist on all the brokerage platforms. Now, some of these brokerage platforms may call it something different. Okay? Now, I'm going to tell you what these mean and what they could be for yours. Now, it doesn't mean that this is going to be exactly like yours in your brokerage platform. So your brokerage platform may not call it OCO, which is called open conditional orders. They definitely will call stop orders, and market orders. But this first one may not be the trace. Okay? Now, in an open conditional order, what's going to happen is that I'm going to put an entry. So let's say I'm betting on the instrument going up. So I'm going to put a buy order. But at the same time, whenever the buy order gets filled, I wanted to automatically place a stop order and a target. Okay? So these 2 orders, the stop and the target, do not get placed until the buy gets filled. Everyone understand that? So the very first order has to fill in order for these 2 to take place. Everyone okay with that? Or no? Anyone here? Live? Hello? Is that yes? Is there a no? Okay, someone had a question? Okay. Yes, what was the question? Hello?
Hello, can you hear me?
Yes, I can hear you.
Okay, so this OCO, you are defining the transaction states, right? That first thing you, I mean, like, in order to this whole transaction to run properly, the three conditions have to be met, right?
But what has to happen is the very first condition has to be met before the other two orders are placed.
In
Okay?
the same instrument, right?
Yeah. So let's take a chart. Okay? So give me 1 sec. So let me come out of PowerPoint, flip over a chart to you. You see my chart here?
Yes.
Okay. Now, let's say I want to buy. Okay? And I want to buy, I'm going to buy here. Okay? But I'm going to buy this when price comes up to that price, and then I want it to automatically buy. You okay with that?
Yep.
Okay. Now, I'm going to put this order out there, but this may fill when I'm sleeping. Okay. So the problem is, I don't want to go to sleep putting a buy there, and then all of a sudden this thing could crash all the way down there. Right? Yep. So what you could do is you could put an OCO order where you put the buy here. Okay. So this is going to be your buy order. Okay. And then what you could do is you could say, I want it to have a stop here. So just in case if I'm wrong, I want to get out. Okay. And then let's say I want to take my profits here. So this is my profits. Agree?
All right.
So what you could do is you could place what you call an OCO, right? Where this will be the first one. This is the main order. Okay? And these two only get sent to the broker when this one gets executed. So if price goes all the way down, this will never trigger and that will never trigger. These two only become active, this take profits and stop only become active if this one gets triggered. So the buy order has to get filled in order for the stop and the take profits to get filled, to be put. Does that make sense?
So I mean, for a beginner, I only see 3 green lines, right? And like, if I go from bottom to top, I mean, like the execution, you know, the steps. For every line, we need to define the type of action, right? Is it a buy action? Is it a stop action? It's a sell action, right?
Yes. Yeah, and I'm going to show you that in a minute, how to do all that. Okay?
All right.
Hold on. So, okay, so now, so if you look at these, right, these two are conditional. So these are different. These orders don't even go through to your brokerage at all. Okay? They only become alive, active, once this order is filled here. In order for that to be filled, price has to come up there, touch it, and then it gets filled. Does that make sense?
Yep.
When that becomes live, guess what? This will become live and that will become live, right? And if price comes up to here, it'll automatically get you out, giving you profits, and this will be canceled. So these two are dependent on each other. If this one gets filled, this one gets canceled. If this one gets filled, that one gets canceled. Does that make sense?
Yeah, for sure, yeah.
So these are conditional orders. Okay. Rebus, we're not talking about limit orders yet, but I'll get there in just a sec.
All right.
You okay with that?
Yeah, thank you.
Okay. Okay, so
We have another question, Manish.
yes.
Mohammed Galan.
Yes, Mohammed.
Oh no, you answered about the fill. That was my question exactly what the fill was.
Okay.
So I'm good right now.
Okay, perfect. Okay. Now, stop orders are where you price where the position gets you out of the trade. We're going to talk about that in a minute. Market orders, I want to get out now. I don't care what the price is, I want to get out. Does that make sense to everyone? Yes? Now, this is a little tricky. Okay. So now, let's not do this. Let's go straight to a live chart. Okay. Now, here's what we're going to do. I'm going to come over here. Let's say here's my price. Every price is going down, down, down. Everyone see that? Everyone okay with that? Okay. Now, listen to my words carefully. Okay. Right now, price is going down, down, down. Okay. I feel like this thing's going to go up. That's the example I'm giving you. Okay. So I only want to get in once it starts going up. So imagine this is a train that's getting ready to start going. Okay, it's at a depot. Okay, it starts moving, moving, moving. Guess what? I'm going to jump on that train only after it moves down a certain amount down the path. Because I know if I get in there, I'm not going to get caught trying to get on the train without paying. Okay, so I'm going to sneak on this path right here, and I'm going to sit there and get this train, and I'm going to ride it all the way up to there. Everyone okay with that? Okay, so if I'm sitting there trying to get on the train in the same direction that it's trying to go, this is called a stop, a buy stop order. Okay? Why? I want the train to stop just for a sec so I could get on to, right, and get on the train to go up. Everyone okay with that? Buy tells me I'm betting on it going up. Stop tells me, hey, stop for a sec so I can get on the train, and I want to get on the train in the same direction you're going. Everyone okay with that? Yes? Okay. So that's called a buy stop, right? Now, let's say I get on the train, all of a sudden, guess what? They got mechanical problems. Now they have to sit there and go backwards. If they go backwards and they come further back and they go too far, the train may break. So if the train comes all the way here, guess what? I'm going to jump off because I know the train's going to be broken, right? So at this point, I'm going to get out of this trade. This is when I'm wrong, I want to get out. So I want to automatically get out. So this is what we call a stop order. Everyone okay? Okay? When price gets here, whenever price touches this stop order, it's automatically going to get me out at whatever the price is trading at now. So the stop order becomes a market order, and it gets me out. Everyone understand that? Since I basically bought to get in, I have to sell to get out, right? So it's going to sell here at whatever the buyers are asking for at that time. Everyone okay with that? So this is called a sell stop. The reason why is I'm going to sell to get out of my bought position, and I'm doing it to get out. Okay? Go ahead. You're unmuted. You had a question.
Okay, I don't understand the difference between the previous scenario, the OCO, the conditional one, and this one. What is the difference? I mean, like you're buying and selling.
I'm just defining the brackets. So, like, do you have you had these two orders?
Mm-hmm.
So you have these two orders that only take place. You got to define what they are in a brokerage. So, like here, like if I do like here, watch. If I come in here, right mouse click, okay, and I say buy custom with OCO. You see that?
Mm-hmm.
So now this thing pops up, right? The green tells me I'm going to buy. I'm going to buy at this 41.68, which is 41.69, right?
Mm-hmm.
Now this tells me a limit. Well, guess what? This right here, it could be a limit. I could choose market, limit, stop, or trailing. You have to choose which one you want to be in. If you put the wrong one in, it's not going to do what you need to. Does that make sense? In this scenario, I have to change a stop to a limit to a stop. This is a buy stop because what's happening is price is going to go up and then I'm going to buy it. Does that make sense?
I mean, like, just like stocks, when you are putting a position, right, you are trying to buy something, there are, I mean, like, all these options show up, like, you know, stop market or whatever, are you trying to buy the market price or whatever. So the point here is, like, either you want to fill the whole lot or, like, step by step. So, like, first few stocks, first few, like, you know, like in a lot of 10,000, first 100 got filled with like 148.68. Then the other 100 get filled by 146.
But you're not partial filling here. You're going in with 10,000, which is one mini lot. It's not partial. You see what I'm saying? If your goal is to go in with 10 mini lots and you want to go one now, two later, you could do that. That's no problem. Okay? But the thing here is that what's happening here is, let's say you want to buy here. Okay? So price has to go up and meet it, right? That's called a buy stop. If price is going down and then you want to buy it as it's going down and thinking, okay, this is a bottom, this is called a buy limit order. Does that make sense?
Well,
No.
to me, you are just trying to buy something, right? So
No, but think of it this way. But you can't, because in the stock world, it's the same way. You just may not know of it, okay? If you're betting on this instrument going up, right? And if I try to buy here, what's happening? Price has to come up to get there, right? That's called a buy stop. Okay? If price is here, it's got to come down to meet me, right? So I'm trying to predict the bottom and then buy to go up. That's called a buy limit.
all right, all right, all right.
Does that make sense?
Yep.
Remember, if I'm sitting there, if I need price to come up and meet me in the same direction as I'm betting on it, that's called a stop. Okay? If price is not going in the same direction, like it's going down here, and I'm trying to bet on it going up, I'm trying to get in front of the train thinking where it's going to stop. That's called a buy limit. Does that make sense? Or no?
Yep.
Still a little iffy?
Little bit, because like I mean, like, you are watching the trend. The trend might either be going up or going down. I mean, like, I mean, like, these are only terminologies, right? You are
No, but
defining
see,
the terminology.
in the stock world, when you're saying, okay, it's here, right? I want to buy. You go in and you buy, right? You buy at market price. Agreed?
No, we can specify the option, right? For example,
Right, but when you do it, what do you do? Let's say here, AIG. Right now it's at 25.39, right? If I'm buying this, do I buy it right now, or do I wait for it to go up higher, or do I wait till it comes down and then buy?
To come down like 24-ish something.
Okay, so if you're going to wait for it to come to here, this is called a buy limit order.
All right.
And it's automatically always set to limit. Does that make sense? If I wanted price to come up here, and then I buy once it comes up here, this is called a buy stop order.
All right, now I got it.
We just have to put everything in AIG world for you. Okay?
All right, thank you.
Okay, so in this scenario, remember, price is right here. Oh, okay, hold on. Yeah.
Manish.
Yeah.
Sorry, we have another gentleman, Mr. Tariq, is looking to ask a question, please.
Okay. Go ahead.
Tariq, go ahead.
Yes,
Tariq.
my name is Tariq. When you, excuse me, when you set the higher range where you want to take your profits, for example, before it touches that range, the trend starts going downwards. It never touches your profit range. So what do you do then? You just sit down and we hope that it comes back up there, or you set up, reset your profit targets?
Okay, so let's say this is your buy order, right? This was your conditional order. This was your stop, and that's your target, right? Price went up there. It didn't quite get to your target, and then started going down, right?
Right.
Okay, that comes down to your strategy, your trading plan. Okay, once we get into the technicals, we'll start building different strategies, right? and we'll go through that. But what will happen a lot of times is, in order for you to be a successful trader, you can't have the stop always there. As price starts moving up, your stop needs to keep on moving. Does that make sense?
Okay.
Okay. So what happens is that if it doesn't get to your target and decides to reverse, you may get out here where you make profits from here to here, because your stop is moving up and up. As price goes up, you want the stop to keep on moving up with price.
So you can do like a floating order?
It's called a trailing stop. It's called a trailing stop. See this?
Okay.
If I change this, see the trail stop right there?
Okay.
What that does is that changes to its trailing stop right there. And you could change these stops to be a percentage, or you could be a certain value. You could say, I always want it to be, as this moves up 10 pips, I always want to move mine up 10 pips.
Okay.
You see what I'm saying?
So
There's
you have
various
that
ways you could do that. Yeah.
Okay.
You could do it manually, or you could set it to a trailing stop in your brokerage platform, or you could go whichever way you want.
So what is a typical way of doing it? You do like trailing, or you would do a fix, or?
Well, it's hard to answer. Reason why is that comes down to your strategy. Okay, a lot of strategies will use trailing stops. Others will have another calculation that is there. And what will happen is, once we go for all the technical indicators, right, what will happen is a lot of times, a lot of people will use the technical indicators as stops.
Okay.
Okay, and when the technical indicator changes, you change with it. So the answer to your question, believe it or not, is not as simple as it sounds, and you have to kind of wait till once we get to the technical section, because it varies based on the technical indicators you have and the system and the strategies.
Okay.
And it's hard to say this is the best one. Reason why is everything varies with time and the strategy. So one strategy may, it may be profitable with a trailing stop. But if you sit there and you use a hardcore value, that strategy may fall.
Okay.
Okay? Like in my technical system, mine's based on indicators. It's not even a percentage or a trailing. It's based on the indicator. So as the indicator moves, basically my stop moves with it. And we'll go through all that. Okay?
Alrighty. Thank you.
Thank you. Any other questions? No questions? Wow, you guys got that?
I guess nobody's asking a question, Manish.
Okay. No one
Hang
is?
on 1 second. 1 second. We have Rebus.
Yep.
Rebus, go ahead.
Hello. Yeah, I was just wondering about these trailing stops, and I've noticed when I've been playing with, the pretend accounts that you can set trailing stops up with your broker. And but what happens if you go offline? Does it like forget about you and just disappear?
Well, I think that leads to almost like a question we had earlier. In majority of these stops, orders, and limit orders, these orders right here, this one, and this one, if the brokerage platform, even when you close it down, they should still be valid. Okay? Now, that's something you have to check with your brokerage platform, because if they're archaic, what may happen is they may cancel all your orders when you close it down. Now, the chances of them doing that nowadays with all the technology is very rare. Okay, I know for like in this platform, when I put an order out there, when I close it, all these orders are still active. Okay, so all orders are independent of whether if I'm open in my account or not in the account. And the reason why that's critical is let's say you had an open order out there. If you have to have your brokerage account open, and let's say you had a power outage for 3 or 4 hours, and you don't even have your charting application open, and it's dependent on that, and the market moves, you could be losing thousands of dollars. And that's one of the reasons why it's irrelevant now, a lot of brokerage platforms, whether you're in your charting package or not, whether you're logged in or not, these orders are still live no matter whether you're logged in or not. But you have to verify that with your brokerage platform just to make sure. Remember, we don't want to make any assumptions at all, and then that one fluke day it does happen, we made an assumption, before you know it, we've blown out our account. It's better to ask than assume.
So check with your broker.
Yeah, check you with your broker.
Right on. Thanks.
And the question you would ask with your broker is that, you know, when I shut down my account, when I shut down my application, are my orders still live in the background on your servers?
Right, exactly. Thanks.
Thank you.
We have another question, Manish, from Tariq.
Okay. Hey, Tariq.
Tariq, go ahead.
Yes, Manish. If you are setting a day trade and you set your trade and during the daytime, the trade doesn't take place because your conditions did not meet. So at the end of the day, it gets wiped out or it gets carried over to the next day.
Well, you notice over
or you
here.
reset again the next day.
Well, here's the thing. In the stock world, you have an option to choose day or GTC, which is good to cancel. Okay. In a stock world, when you choose day, whenever the markets close, that order will automatically be canceled. And if you put it to GTC, it will carry over until you cancel it. In the Forex world, this market's a 24-hour market. Notice when I click on this GTC, I got no options at all, right?
Okay.
Now watch, if I type in AIG, a stock world, right? And I come down here, notice this says day and GTC and all these other options, right?
Okay.
Notice in the currency world that doesn't exist. That means it's there until you cancel them. It means you have to cancel them. It will always be there.
Otherwise, it would sit down there.
Otherwise, it will sit there forever. And if you forget about it, guess what? It'll come back and haunt you.
Okay.
And believe it or not, that happens to a lot of Forex traders.
So is there any way you can track your trades or your trading history or your trading pattern or?
Well, like orders?
Yeah, all the orders in the previous history, let's say, past 1 month, what your strategy was and whatever the trades you did, the profits and losses and all that.
Well, I mean, your brokerage platform is going to give you your account summary, but it's up to you to create
kind of
your trade book. Yeah, your statement, but it's never going to tell you the strategies or anything like that, right? The best thing for that type of scenario to do is kind of do what I call a trade book, right? You could sit there in a trade book. What you could do is when you enter a chart, go ahead and print it out. At the bottom of the chart, write down the strategy or any other information notes and keep it in the book. Or you could keep it online. You know, it's kind of called a trade log, and that comes down to individual person and how you keep it, what information you keep, and stuff like that. But believe it or not, if just you thinking about that is very good, because now you're starting to think like a true business. A true business will have all these things, and believe it or not, if you don't remember what you did in the past, then how are you going to analyze it to figure out what mistakes you've made? Remember, in trading, the losses are what matters, not the winners. And if you don't have a trading log of your losses on the strategy and stuff like that, there's no way you could see there's a pattern in your theory. If you notice there's a loss over and over and over with one concept that you had in your trading plan, you could easily see that if you had a trading log. If you didn't have a trading log, you're never going to see it.
Okay. Thank you.
Okay, thank you. Any other questions? Okay, so remember, if we do it here, if price is going down and we're betting on it going up, if we're going to try to get in front of the train and try to predict where it's going to stop, that's called a buy limit. Okay, if we're going to wait for the train to start going in the direction that we're going, and then we get on, that's called a buy stop. Everyone okay with that? Okay. And now here's the part that's confusing. The place that we get out when we're wrong is called a stop too. The price that we get out when we're profitable, this is called a sell limit. So this is where it gets confusing. These limits, stops, and all this stuff, it gets confusing. Here's the thing to remember. If you do an OCO order, right, all you have to do is do buy custom OCO. Keep everything the way it is. The only thing you have to change is the buy order, the first leg. Okay? If you're going to try to predict where the train's going to stop, keep that to limit. If you're going to try to get on the train as it's moving in your direction, going up, then you just change that to a stop. That's it. Everyone okay with that? Please tell me yes. I know everyone's got a 10-minute attention, 20-minute attention span, but please bear with me. Get up, do some jumping jacks or something, but we'll loosen up. We had a question?
No.
Okay. Now, let's throw a twist in this. That's on the buy side if you're buying something, right? Let's assume you're trying to sell something. Let's delete these guys. Let's say you're trying to sell, okay? And what's going to happen is the train's going this way, and now you're going to predict where it's going to stop, and you're going to sell. Just like before, if you're trying to get in front of the train and predict where it's going to stop, it's going to be called a what? Sell limit. Instead of buy limit, it's now called a sell limit, okay? If you're wrong, it's going to be here. So this is now going to be your stop, but it's now called a buy stop. This is when you're wrong. Okay? This is when to get in. Okay? And if you're trying to get to your profit, let's say your profits are down here, then that's called a buy limit. Everyone okay with that? Now let's say you're getting, the train decides to keep on going down, down, down. Let's say you want to sell here, which is trying to get on the train in the direction. Well, guess what? It's called a sell stop. Now, this is maybe hard for you to remember, but here's the things. The only thing that you don't have to worry about this when you're wrong. This is always going to be a stop, and the broker will automatically call it a stop. So you never have to change that. This is always called a limit where you're going to take profits. You don't have to remember that. So don't forget that. The only thing you have to remember is these two things. Okay? And the only thing you have to remember is if you're trying to get on the train as it's going in the direction that you want it to go, it's called a stop. You want the train to stop for a sec so you could get on. If you're waiting for if you're trying to predict where the train's going to stop and then go in your direction, that's called a limit. Everyone okay with that? Yes?
Yep, we have no question, Manish, so far.
Okay.
No question yet.
We're almost done for this first section. Okay. Now, so we pretty much have wrapped up the first module that I wanted to get into, which was talk about why you should trade the currency market and why you should sit there and how you could trade it, how you could buy orders, sell orders, everything out there. Okay. Now, I want to give you guys an insight what we're going to be discussing in the next 2 months. Okay. One Wednesday, we're going to go for the fundamentals. Okay. What we're going to talk about in the fundamentals, there's going to be 3 chapters that we go for in the fundamental module. The very first chapter is going to be how do fundamentals affect the markets, where we're going to talk about interest rates, what do they do, how they affect it, how money flows due to interest rates and stuff like that. And then chapter 2 is going to start getting into all the fundamental indicators. As the user earlier suggested, we're going to talk about debt, unemployment rate, job reports, what these indicators, all these fundamental indicators that keep on coming out, how they affect the currency market. Okay? And then in chapter 3, we're going to talk about currency correlations. When gold goes up, what currencies go up? When oil goes up, what currency goes up? So we're going to talk about currency correlations with other instruments in the markets, such as futures, such as stock markets, and stuff like that. Okay, that's the fundamental module. The technical module is going to be a very detailed module. Okay, Chapter 1, and we may change this. I may change this as time goes on, so just don't hold me to this. But if it changes, it's going to be for the better, not the worse. When we go through the technical agenda, we're basically going to go through, we're going to start from the very basics where we're going to discuss what a bar is. Okay? We're going to go discuss all the different types of bars, from Japanese candlesticks, the Hakinashi candles, to regular bar. We're going to talk about time frames. Okay? So this will give you an idea of how a chart, a technical chart, is built up. Then we're going to talk about support resistance. Reason why is trading is all about support resistance. That's all it is. Okay, so we're going to spend a whole chapter on just talking about support resistance. What is it? Why is this important in trading? And going from there. Then chapter 3, we're going to start discussing all the various technical indicators, the most popular out there. We're going to cover volume, moving averages, MACD. We'll cover MACD BB 2. Technical indicators 2 in chapter 4. We'll cover CCI, RSI, average true range, Bollinger Bands. Then we'll go into average over here, line patterns. We'll go into Fibonacci's. We'll go into chart patterns and move forward. And then we'll go into Elliott wave theory. And then we'll talk about pivots and pullbacks. Okay? So we're going to sit there and we're going to go for all these technical concepts, and we're going to teach you step by step every way as we move forward. Okay? We'll talk about how some people are sitting there trying to combine two of these indicators into one to try to charge money. We'll talk about the advantages, disadvantages, each of these indicators, everything out there. Okay? But the key thing is at the end of this whole scenario, you should know what each of these indicators offer and how it could fit to sit there and make a trading plan. Our end goal is to be what? Successful, consistent traders. In order for you to be a successful, consistent trader, you have to have a trading plan. It's just like you in the business world having a business plan. Let's say you wanted to open up a Dunkin' Donuts. You have to have a business plan in order for you to sit there, go to a bank and get money, don't you? Same scenario. You're going to have a trading plan. At the beginning of your trading plan, you need to outline what is your goal as a trader. Is it make $1,000 a month, $2,000 a month the first year? What? Or is it sit there to be a 20% gain the first year? What are your goals as a business, right? And then 2, what is your competition analysis? 3 would be, what is your strategy, which is your technical plan? What indicators are you going to use? How are you going to use them? Okay? The 4th is basically, what are your entry rules at entry? Okay? Is this indicator has to be this way in order for me to enter? This indicator has to be this way for me to enter. This fundamental data has to be good in order for me to enter. Whatever may be the case, you have to put your entry rules. And then lastly in the business plan, you have to have a money management section. Okay? It's very easy, believe it or not, for traders to be profitable, to make money, but it's very hard for them to keep it. That's where the consistency word comes into play. So many traders have good systems out there, and where they definitely sit there and they get everything correct, where the trade will be profitable during the trade. But the problem is they can't keep the money. So that's where the money management module is key. And when we start talking about money management, we're going to start talking about trailing stops, what they should be, how you should use them, where they should be, right? Where you should be, what you call in the preserve mode and stuff like that. So we're going to spend a lot of time on the money management at the end of this technical module. We're going to help each of you guys come up with trading plans, okay? Now, I will tell you one thing. Not one person is going to have the same trading plan as another person, okay? Trading plans should be fit to your personality and what your desires are as a trader, and to also your strengths, not your weaknesses, okay? So as you go down this 2-month journey, you're going to learn what you like to do and what you don't like to do, okay? And that's very key for you to understand, because trading is all about going down a journey, what you like to do and what you don't like to do, and work towards your strengths, not your weaknesses, okay? And I will tell you this now. The simpler the trading plan, the better, successful, consistent trader you will be. The more indicators you have in your chart, the more doomed you're going to be. Okay? And I guarantee you that, and we can show you that a little later at the end of that 2-month journey. Okay? So, let's wrap up what we've done today, and let's just go make sure we've gone through our agenda for today and we've covered everything. Basically, in our agenda, the first chapter was why do we trade the Forex market? We discussed that. The biggest reasons was liquidity. Over $2 trillion traded daily in the currency market, and it's a 24-hour market, right? There's only 12 major pairs going up to 37 if you really look at it, and most of those pairs are trending, either going up or going down. So it's a very high probability of you being right compared to being wrong when you're trading a sideways market. Okay?
We have a question from Muzammil.
Okay.
Go ahead.
Okay, when you were discussing that slide with the fundamentals and the technical indicators, right? While doing this, Forex trading or whatever, do you think that it mostly depends upon the fundamentals? Technical indicators are just, some formulas or some like algorithms that are man-made, right? And it's mostly depend upon the fundamentals, right?
No, okay, so now this is not a fact, this is opinion, okay?
Okay.
Whenever you ask that question to anyone, there's no facts involved at all, it's all opinions. And opinions are based on their experience as a trader, okay? I started down a path of being a fundamental trader, and I lost, okay? And the sole reasons why is I know all the fundamental data and everything, but the problem is it's delayed data. What you believe fundamental, the people will react maybe 2 months down the road from it, 3 months down the road from it, or whatever. And it's also a matter of interpretation. Okay? So I learned not to be a fundamental. I'm more of a technical trader now. And the reasons why is I trade what the price does, and price tells me what people are believing. And that's what I trade. It's like giving you an example. You know Apple's coming out with an iPad coming up, right? You know they sold it. They had great earnings, everything, right? Earnings is coming up. Well, guess what? You're gonna buy. Earnings comes out. It's great, but guess what? The stock goes down. Right? Same thing. Now what do you do? Right? It's the same thing. If you look at the currency side, right? You have U.S. yen and U.S. Switzerland. Okay. So Japanese don't want their currency strong at all. Reason why is if their currency is strong, they can't export. It's expensive to export. So it's expensive for people in the U.S. to buy Toyota cars. Does that make sense? If the currency is strong. Well, what's happening is everyone believes fundamentally is that the Japan currency cannot be strong for such a long time. If it does, it's going to destroy the Japan economy. Well, guess what? So everyone's been trying to bet on the currencies trying to go weak, right? And they've been betting on that for 8 months, and it's still not going. All these fundamental traders now are 8 months, and it's still not going. I have a friend that's a fundamental trader, right? He's in a hole big time because he's still betting on the U.S. yen going up, and that thing's still going down. You see what I'm saying here? And that's all fundamental. People are saying it cannot go lower. It can. It's the same thing. 2 months ago, we launched in London, right? Went to London. People were saying that the U.S. yen could not go down another 400 pips. And I was like, yes, it can. Never say never. They're like, no, it can't. The economy would be destroyed. Anything can happen. The moment that you think that you've got these markets cornered, you're going to lose. You're going to lose, and you're not going to be prepared. If you think worst case scenario and you believe in the things that can happen, and you're prepared, you'll be the most successful trader out there because nothing will catch you off guard, and you'll be ready for the worst case scenario to happen, and you'll be prepared. So never think that you got these markets cornered, I'll tell you that now, because they'll take you for a ride, the biggest ride of your life. And you know,
Or
I'm talking, I mean, I have over 18 years of experience, and trust me, I've blown out my account 3 times. I was in the internet bubble, and I lost everything when that bubble busted. Okay? So it was the biggest reality shock for me ever. But I learned from there and moved forward.
So, so what you are suggesting, I mean, like your opinion, I mean, like your advice to, like, you know, for the people like me who are just beginning or whatever, like that always go for the technical side, right?
Well, I'm not telling you to make any judgment calls right now, okay? Reason why is you have to believe what you feel. You have to go to what makes you comfortable, okay? So what I'm saying to you is don't make any decisions right now, okay? Go down this journey, learn everything, gain the knowledge, okay? And then at the end of that journey, decide what you feel is good and what you're comfortable with, okay? Remember, this is just a probability game, okay? If you feel comfortable with the fundamentals, that's fine, but at least involve some technicals to confirm your fundamentals.
All right, perfect.
You see what I'm saying? So I'm not saying don't go down one extreme or the other extreme. You got to find what works for you, okay? But like when we go to fundamentals, you're going to see why there's 6-month delayed data, delayed reaction. Right? So you're going to see the weaknesses. You have to compensate for the weaknesses. So right now, no one really should be making any decisions at all, especially as a beginning trader. Your goals is to gain knowledge, right? Gain all the knowledge I have in my mind from 18 years of experience and get that in yours. That should be your sole goal for 2 months. Okay?
Perfect.
And then at the end of that 2 months, then you could decide which route you want to go. I'll actually be in Toronto at the end of that 2 months too. So we'll have actually a live meeting there too.
Perfect.
Okay? So we could sit down, we could go for everything with you, but you know, don't sit there and make conclusions or anything right now. You got to sit there and look and do everything. The other thing is you got to validate everything I'm saying. Don't take everything I'm saying for granted. Take all the information I had given you and now go out and research it and validate everything. Okay? You always have to validate the speaker, no matter who it is. Okay? Because there's so many speakers out there that are not traders at all. They're just they're educators. Okay? And believe it or not, experience is what matters in this industry. It's not what you know, it's the experience that you bring to the table. That's what matters. Okay?
All right. Perfect. Thank you.
Thank you. Rebus, you had a question? Yep, Rebus, Rebus had a comment that says you can't predict the market direction, only make probability estimates. That's perfect. It's like you going to Vegas and playing blackjack, right? What are you doing when you're playing blackjack or playing poker? You're playing the probabilities, aren't you? If you're just randomly doing it without a system, then you're gambling. But if you're trading a system, then you're not. You're just playing the odds. And that's the same thing that you're doing with trading. This whole business is all about probabilities. This is why I said keep your trading strategies simple. The simpler they are, the easier to execute and the easier just to play the probability odds. That's what it all comes down to. Okay? Any questions while we wrap up? Now, you guys have my contact information. Just in case, if you don't, here's my contact information. You can email me. I am on Skype too at mpatel4001. If you have any questions, you could email me, or you could email at info@eiicapital.com, and our staff will answer your questions. The same password will be used for the next time. And give us a couple of days and we'll send out the video to everyone. But please make sure that you go for this video again before the next seminar. It will really, really help you if you can. You can skip for the boring parts, just press forward. But please go through the video again. Make sure you understand everything because we are building upon seminar to seminar and seminar. Okay? That's it. Is Thinkorswim available in Canada? Rebus, it is for charting purposes, but not, I think for trading. Vinesh, can you answer that one? Thinkorswim in Canada?
Yeah, sure. Rebus, Thinkorswim is available for Canada, but the minimum deposit they require is 10,000 Canadian dollars. Besides that, they also do not allow you to either trade Forex or trade futures, or even trade Canadian stocks. With $10,000 of investment or a deposit, they allow you to trade only the American stocks, as of now.
A lot of my students, Rebus, are using Thinkorswim for charting purposes, mainly in Canada. And the reason why is it's a great platform for alert system and stuff like that.
One of the features, Manish, that I might mention to Rebus is that like Manish said, that it has an alert system. What we do as students is that we do the alert and put our emails. So every time a point gets hit, we get an email alert on our cell phones, and we go check it up, and we really don't need to sit in front of the computer all day long. That's one of the features that Thinkorswim has, and we all pretty much in Canada are using it for charting system, and we have our own other platforms for trading.
Yeah, and you don't have to have the platform open at all for alerts or anything. So literally, believe it or not, for stocks, futures, and currencies, everything I trade, I got over 100 of alerts out there. And we'll talk about alerts and how to do them for trading. Because believe it or not, no one out there sits there and talks about alerts and how you could use them for trading. And believe it or not, we only look at charts when we get alerted for a trade.
All right.
Yeah, okay. Is that a question? Is Quest trade? I think that's it, isn't it? Okay, everyone. Have a good night. Thank you for attending. Please, oh, by the way, please give us some feedback improving things via email. We always want to keep on improving things, so please provide us feedback as much as you can. Oh, Vinesh, there was a question, I think.
Okay, Muzamil, go ahead.
Yeah, my last question for tonight is like, I do the stock trading through the Quest Trade web platform.
Mm-hmm.
So, do you think they do have the feature of Forex trading as well?
Mm-hmm.
But I haven't signed up for that particular module, right? So if I go with that kind of a web-based platform, is that okay, or I really should get into Thinkorswim or NinjaTrader or whatever?
No. Okay, so one, I use Thinkorswim myself. Okay, we're not affiliated with any brokerage or charting platforms out there, so you could use whatever you want. Okay. But you have to inquire about the brokerage platforms, make sure that they're stable, they got all those, meet all the criteria that you need. You see what I'm saying? I have gone for a whole bunch of them. I personally, what I do, because remember, I live in the U.S., right? So it's a platform where I could get futures, U.S. stocks, and currencies, everything in one platform. There's no limitations for me here in the U.S. But you as Canadians, there's some limitations, as Vinesh says. So, my students in Canada are using it for charting, and they're placing orders with another brokerage platform. So, I would really encourage you to go and investigate how Quest Trade does their Forex.
Mm-hmm.
When you're evaluating Forex platforms, one, we're going to talk about this, make sure they're non-dealing desk, okay? So the spreads vary. Okay. 2, find out what the spread is for the Euro USD, and make sure you could get 2 pips or less. Okay. 3, find out if your money's protected. 4, find out what the minimum deposit is, and then evaluate the platform to see if the platform meets all the requirements that you want it to meet.
All right. Thank you
Muzammil,
very much. Yeah.
if you have any question with regards to platforms, you may call me sometimes tomorrow afternoon, and if I can, I'll surely help you out.
Oh, Manish, thank you very much.
No problem.
Well, by the
Anybody
way,
else who
you
has any
mentioned local.
questions?
Yeah,
I'm local in Mississauga, so anybody who feels like he needs to know any question about platforms or any other thing that Manish has explained and he has not been able to understand, more than welcome to call me, and if possible, I shall try and help him out.
May I have your contact information?
Yeah, my phone number is 416
Mm-hmm.
800
Mm-hmm.
4647.
Perfect.
Yep.
If you're nice, maybe he'll buy you a coffee too.
Okay. Good night, everybody. Thank you for attending.
Okay.
And see you next week.
Thanks, everyone. Bye-bye.
Thank you very much, Manish.
Bye-bye.